Welcome to the Ramp Up to Retirement podcast with your host, Dan Reese. Dan, when we last visited, we talked about the dangers of do-it-yourself retirement planning. And today, we're talking about the value of a dollar.
Yeah.
People will want to listen to this one because who knew a dollar could cost you so much money? You're going to have to explain.
Yeah, no, I'm excited about this because, tacking on to last episode where we talked about doing things yourself, which a lot of people want to do nowadays and feel like they can. There's a few things that I thought about after that I thought, we should talk about this because we've ran into this with clients, where they haven't understood this and they've run into some major problems with unexpected tax bills, right? And so that's kind of what this comes down to. So we're going to get into a few of those today, but it is crazy because most of our tax code, things are kind of gradual, right? So it's like, you slipped into the next tax bracket. It's not that big a deal. It's only a few dollars taxed at that level. When you do the math, it's really not that big of an issue.
Right.
But what we're going to talk about today are some of the things where that's not the case, where it's actually you literally go $1 over and all of a sudden things change or can change dramatically. And so hopefully this will be helpful for people listening to understand, hey, these are things that I need to pay attention to because I probably didn't deal with much of this when I was working. But as I enter into retirement, these are real issues that can really bite you. So hopefully it's valuable for everyone.
Well, no, I know. And just looking over the notes, I learned things I didn't know. And I've been doing this for a long time. So, I didn't realize that really and truly, this is not hyperbole for those of you listening, the difference a dollar can make is profound when it comes to retirement income. Because there is no phase in here, Dan. You're going to have to lay this out for folks.
Yeah, I think, and that's the thing is, and we're going to really focus on three kind of key areas, which is they're the most common ones that get people. And so we're going to talk a little bit about what's called IRMAA, which is really your Medicare premium. The government's got to have a fancy title for everything. But in essence, what that is, in today's dollars, it's around $185 for Part B when you're on Medicare per person. But we're going to talk about how that can quickly change and you can get into much higher premiums if you don't understand the rules. We're going to talk a little bit about Social Security, and that's probably one of the most confusing areas around taxes for retirees, like understanding like what's taxed on Social Security and how that can change. So we're going to touch that. And the last one we're going to touch on is something that's been around now for quite a few years, the Affordable Care Act, where people often have to buy their insurance coverage if they retire before 65. So they've got this gap between when they retire in 65. And a lot of times you end up going to the exchange to get that coverage. And they ask you a lot of goofy questions that most people don't even know how to answer about their income. But they're important questions because it does determine your premium. And so we'll get into that a little bit. But all three of these areas, it's interesting, like $1 over a certain threshold and things change like right now. It's not it just was a little bit. It didn't make much difference.
Well, let's start with first plain English language. Let's start with the cost of Medicare, aka IRMAA. How does a dollar affect that?
Yeah, IRMAA is interesting because what happens is that this is one that I would say is more likely to sneak up on someone. And the reason I say that is that there's a couple things that we've seen where people get this surprise letter from Social Security once they're 65. So keep in mind, you have to be on Medicare for this. And they get this surprise letter that, your benefits are going to be reduced by X number of dollars because you went over the limit. And so you have more premium to pay. Typically, a lot of people pay that out of their Social Security benefit, right? It's deducted from that.
Yep.
That's where that letter comes from. If you're not on Social Security yet, you typically are going to pay it by check. But regardless, you're going to get a love letter. It says it's a lot different than what it was, right? So either way, you're going to pay that. But the thing to understand about it is the reason I say it creeps up on people, sometimes it's a single event. Like maybe they sold like a business or some old, highly appreciated stocks. And so they had this really kind of an anomaly year where all of a sudden they've got this, much higher income than they typically have. And so, like, all of a sudden, their household income, and this is under, I don't want to get into too much in the weeds, but this is based on modified adjusted gross income, which is a little different than adjusted gross income. They add some other stuff back in. You can look that up if you want, and you can figure that out. It'll give you a whole description of it. But basically, as a household, typically, if you're a married household, once you get over 212,000, it starts jumping up. So just to give you an idea, like I said, the base premium is $185. If all of a sudden your modified adjusted gross income goes between 212 and 266, now you each pay an extra 74. So if you're married couple, that's basically $150 more a month or $1,800 a year. But also your Part D, which is something some people may be familiar with, that's your prescription drug plan. That also goes up $35 per person, right? So you've got an increase there. It actually doesn't go up that much. It goes up, the base is 13 and it goes up to 35. So that's not as big of an issue, but it's still an additional cost.
Right.
And then there's several levels after that. You get over 266, you get over 334, and some of these numbers are big. But if you have a business sale or something else, this could definitely happen, right? And then all of a sudden, you could be paying up to the maximum amount you could pay is an additional $443 a month, right? And so that adds up.
I want to stop for just 1 second and underscore something, because a lot of people, I think, Dan, think, well, it's fine. I'm not rich. It's not going to affect me. I'm okay. But they are small business owners, and they don't realize that when they sell their business, that income goes into their modified adjusted income and has a huge impact on them. And it isn't for just a single year.
Yeah.
I'm saying that because I want people to understand this is bigger than just oh gosh, those super rich people got to pay more to get their Medicare. It's like, no, this affects ordinary, everyday folks like your neighbor next door.
It does. And it's surprising how many people it can affect. And I would tell you the one-off, like maybe we're talking about where you sold a business. Now, the problem with selling a business is that a lot of times it's multiple years. Like you'll get payouts, like earnouts. There's different things. And so your actual income, even though you kind of feel like I'm not earning that, I'm just getting paid for something that I built.
Right.
But they don't really care, right? It's still money coming in. But that one is actually a little easier to manage because it's kind of like, okay, we know this is only going to be for 3 years or whatever it might be, right? And there's times that you can even dispute it with the IRS and say, oh, hey, this is a really unique circumstance. And sometimes they'll be nice and reduce it back down, but typically you're going to pay it. The one that we see more that's much more damaging is the long-term effect of this IRMAA in Medicare premium, which generally has to do with people don't do proactive tax planning when they first retire. And so these pre-tax accounts, like the 401ks, accounts that you haven't paid any taxes on yet, right?
Yep.
Continue to grow. And then when you get to 73, 74, 75, and you start having these required distributions coming out, then it's like the point of no return. Like you literally can't do anything about it. Like it's just like hitting you every year because you didn't do any proactive planning. So now year in and year out, you're getting hit with additional Medicare premiums. And many times with proactive planning, which we'll talk about some of these solutions in a little bit, that can help you avoid that to a great degree down the road. But we tend to think, oh, that's nothing to worry about. And then you get there and you're like, holy cow, with that compounding of those accounts, that required distribution is much bigger than I ever anticipated.
Yeah. For those of you who think the government does not always get their dollar, you're wrong. They do, especially when it comes to Social Security. And it's interesting, and I'm going to preface this by saying I knew a guy one time who had been very, very successful. Okay, and I was a guest with him on a show that he was doing, and he and I were talking because we were on a friend basis, and he told me I said something about Social Security to him, and he said, "Oh, I don't take Social Security." That's weird, man, because this guy's been very successful. He's probably paid a lot of money into it, and And then I realized several years later, he didn't take Social Security because basically they were going to take all of it anyway when he collected it. Explain what happens with Social Security income, because this is one I think most people just don't know.
Yeah, this is a really complicated topic. So we're going to try to keep it at a high level to make it understandable. But there, you can get into almost PhD level study in this stuff.
Oh
But
yeah.
um, so what happened when Social Security was first created? It wasn't taxable. It was just basically a government benefit that went out, didn't apply to your tax return or anything like that. It was much different, but we'll skip the details on that. But then in the 80s, I think early 80s, they started like looking at it and saying, hey, we should make up to half of it taxable. So we're not saying, when I say half of it taxable, I don't mean a 50% tax rate. What I mean is that if you received 30,000 in benefits, up to half of it, 15,000 would go on your tax return and apply to your adjusted gross income. And so, they did that and they liked it so much. A few years later, they bumped it up to 85%, right? That could be taxable of your benefit. Now, this is what's confusing, and this is what most people think is a little bit unfair. When they created these rules way back for a married couple, if your income, and this is a very complicated thing, but they'd take like half your Social Security plus all your other income. So IRA distributions, like pensions, like all these different things. And if it was less than 32,000, none of your Social Security would be taxed, right? This is for a couple.
Yep.
If it was between 32 and 44, half your Social Security would be taxed. And then if it got above 44, 85% of your Social Security would be taxed. Now, the interesting thing is like most of these numbers that you see are indexed for inflation to keep up, right? So like as an example, in 1985, like 32,000 was a lot different than it is today, right?
Right.
So considerably different. They've never changed them. They're the same numbers as they were back then. And there was talk in this last tax bill of maybe adjusting them, but they did not. They put like a little extra deduction for retirees for a few years, but it's not, those numbers haven't changed. So where we get into trouble with this is that oftentimes, and we've seen this in examples, people need some extra money out of an IRA for a given year, like they need to buy a car or whatever it might be. And all of a sudden, the amount of their Social Security that was taxed increases dramatically. And now all of a sudden, your taxable income might have went from, 25,000 to 40, or depending on how much Social Security you get. And all of a sudden, you have a lot more taxes, right? And you just have to go $1 over. That's kind of the point of this podcast, is that $1 over, and that's taxed. Now you're in the 50% rate. Dollar over the, into that 44,000. Now you're in the 85% of its taxed, not rate. I misspoke there. It's not the rate. It's how much of the benefit is taxed. So it still depends on your total income of what tax rate you're going to pay on those dollars, right? Because we live in this graduated world in the U.S. in our tax system of, as you make more money, you get into higher brackets. So, but it's really interesting because we had a case like this where we had some options for the client of where to take the money from, and they needed a car. And they had some money that was in an after-tax account that they were going to realize some capital gains on if they sold some holdings to buy the car. And then they had money in the IRA. And we ran it both ways, and it was shocking, the difference in the taxes, because the IRA distributions, that income shot them up enough that they had a lot more tax on Social Security, or a lot more of their Social Security was taxable, I should say. And then the other case, it kept them below the threshold, so their taxes were still almost zero. So it makes a huge difference, in understanding these things and how it applies to Social Security is just paramount in making good decisions, with your retirement planning.
Yeah, wow. That underscores what we were talking about in the last podcast. You can do it yourself, but there are risks doing it yourself. And that story perfectly illustrates why working with a financial planner can make a huge difference. And Dan, I just, as a note, I got curious, and I thought, what would $32,000 in 1980 be today? And I ran a quick inflation calculation. That's equivalent to $125,000 today. So
isn't that crazy?
Isn't that crazy? I mean, it's, yeah, and they've never changed it. They've never changed it, to your point. Wow, that's
Yeah.
amazing.
That's a very unfair thing. A few years ago, they finally did change the the AMT, alternative minimum tax, but that got to a point where it wasn't indexed or wasn't indexed enough, and it was hitting all kinds of people.
It was sucking everybody into it. Was sucking everybody into it. It was
Yeah.
just crazy.
No,
Yeah.
it's a really good point. And to your point about, the last episode, the do-it-yourselfers and things, I can tell you when we talk about these things and show them on the screen, because we have some really neat software that kind of visually illustrates some of these things.
Yeah.
They're like, how would anybody know this? I mean, that's the response we
Yeah.
get. And I'm like, well, it is very difficult. And that's the value of, finding someone that has expertise in these areas, because we talk about all the time. Retirement planning is just as much about taxes as it is about investments and income planning. And so the taxes, if you don't get that piece right, you can really be hurting your overall wealth and your net income dramatically, if you're not understanding these different rules and how they work.
It is so much more complicated than you think it's ever going to be. It's amazing, and I'm grateful to you that we're going to keep this at a high level, and hopefully people who are listening to this are moved to call their financial planner or call you and say, "Hey, let's go into the weeds together on this
Yeah.
one," because they should. Honestly, quite
Yeah.
honestly, they should. So you were talking about ACA subsidies, Dan. How does it affect them?
Well, and that's a big one, because part of when Obamacare was created, and I think that's where most people would recognize it. We call it the Affordable Care Act, but most people refer to it as Obamacare. The idea of that is that, providing health care based on your income, right? So that everybody could afford health care. And so for lower income people, they get what are called subsidies. And really what it is, the easiest way to think of that, it's almost like a tax credit, right? It's a dollar for dollar credit that reduces those premiums. Now, the problem with it is that when you go and sign up on the website for the Affordable Care Act, you're like, okay, I'm retired. I don't have any other insurance. I need to get some until Medicare kicks in. You need to put in like your estimated income. And that's a really difficult thing, because most people don't really know, what is my income going to be? How are these different things counted? Do they count Social Security? Do they count, IRA distributions? How does this even work? So a lot of times they're kind of guessing. And the problem is that those subsidies, when you get to a certain dollar amount of income, they completely go away 100%. And it's a dollar over. So like you could have situations where all of a sudden, you might have $6,000 or $8,000, and it's like you don't find out till you do your taxes, right? So you do your taxes and you paid this amount. Oh, I only had $250 a month for my insurance. It was great. But because you went a dollar over on your overall income, then all of a sudden they recapture all of those credits they gave you throughout the year for the premium, and you owe it at tax time. And we just had a case actually this week with this. And it was interesting, because it was another misunderstanding of a person of how taxes worked, and it had to do with some gifting, and they thought that if they gifted money, that would come off their income. So like, and it doesn't, right? And it's complicated. It's complicated, but because they thought that, then they thought, oh, my income is only this, so it's fine. And they owed $4,500 when they filed their taxes, because it was, one of those things they didn't really understand, not only what their income was, but also what came off of that when you were calculating these subsidies. And so I can't stress enough how important it is, if you need health care through the exchange, to understand, how does your income, how's it calculated, what goes into it, what is the threshold where you're going to lose that benefit, so that you don't have any surprises at all when you go to file your taxes.
Yeah. Okay. So this is the bad news part of the podcast. The good news part is coming up, which is there are things you can do. There are ways, strategies you can adopt.
Yeah.
They can help minimize this impact. And I think you need to start talking about those, Dan, because I'm getting stressed right now.
Yeah, no, I mean, that's great, because the thing is like, none of these are surprises if you understand all the rules. That's a good thing. You know what I mean? It's like, oh yeah, we know if you do this, this is a result. It's not like they're trying to hide in the bushes and be like, oh, gotcha. You know what I mean? It's just
Yep.
a matter of understanding the rules. And so, one of the things that we always talk about, and this is probably the best course of action, is to come see us 5 years before you retire. And so we can start looking at what is your game plan? What age are you planning on retiring? Are you going to need healthcare on the exchange? Right? That's a big one. What kind of pre tax balances do you have today? What type of social security benefits are being projected? What do all these things look like? Because the number one thing, if you come early, we can start adjusting your savings plan and building up, maybe some different buckets of money like Roth accounts or after tax accounts, things that are flexible in creating income when you get to retirement. So when you need the car, you need some of these different things, you have different places you can go to get money, right, in order to, ease those issues. But what do we know the truth is? Do people procrastinate, Bill?
I'll get back to you on that, Dan.
Yeah, right, right. So even though we would love you to come in 5 years before, we know that it's a difficult thing to go see somebody. Like, I mean, it just is. You look at all the surveys, people struggle going to see like certified financial planners or a lot of times any professional like a estate planning attorney or a CPA, because maybe, they're a little worried. They don't know what to expect. There's anxiety around that. And so that doesn't happen. I'll tell you, we don't bite, and I hope you don't have that when you get to know us on the podcast and know, hey, we're here to help you, not to scare you. But let's say you're like most people and you wait, you get to like, oh, it's time to retire,
Mm,
right?
yep.
So then it can be more difficult, but generally there are ways to like, arrange things in order to mitigate some of these things. So as an example, you look at Roth conversions when you first retire, when you don't have your paycheck anymore. And so that's that idea of moving money from pre-tax accounts into Roth accounts, paying some of that tax on your own schedule versus on the IRS's schedule if you wait and delay it. And what that does is, number one, it basically pays off the tax bill on that chunk of money that you convert. And once it's in the Roth account, it grows tax free the way the laws are today for the rest of your life. And there are no required distributions on it. And if you do take money out of it, it's tax free and it doesn't affect your numbers for like Social Security and these other things, IRMAA and these other areas. And so it's really nice because it gives you a lot more flexibility in those areas, so you can reduce maybe those kind of phantom taxes that a lot of people don't realize are going to be there, right? That's one thing that can be done. Another thing that can be done if you have big pre-tax IRA balances that are going to cause IRMAA down the road, once you're 70 and a half, you can make qualified charitable distributions out of those pre-tax accounts, which means you can pull money out of those things. And right now it's up to, I believe it's 100,000 a year that, you could pull out to a qualified charity directly. And it's like you never took it out. It doesn't show up on your tax return. It does show up in an area, but they'll put QCD and show that you didn't take it. It went to the qualified charity. And so that's a way to reduce some of those balances through charitable giving. And so it doesn't hit your bottom line and maybe put you into that where you have the IRMAA taxes and things like that, and maybe reduce some of your Social Security.
I think this is a really important point for a lot of people because maybe their charity is their church. Maybe their charity, might be a local nonprofit doing some sort of work that you feel passionate about. But, it is a way for people to not only give themselves a tax break, if you will, but it also helps fund those causes and those things that they think are important and feel passionate about.
Yeah, it's awesome. I mean, QCDs are awesome. We have tons and tons of clients that do those every year. And it doesn't have to be, you could give $500 to some cause, some qualified charity. It doesn't have to be thousands. And you can give multiple to different charities and things. It's really great. It's a great tool without any question. And one of the other things that we talk to people all the time about is called withdrawal sequencing, which sounds like a big fancy term, but really all that is when you look at your different resources, like, Social Security, pre-tax accounts like 401ks and IRAs, Roth accounts, brokerage accounts, savings accounts. How do you use all that in a systematic way to create the income you need, but also to manage these thresholds over time, right? And so that's a big deal because a lot of times people that have been, especially people that have been good with money, like, oh, you know what? I socked away enough in my savings to get me through 2 years of retirement. And then Social Security kicks in and they've got this plan in their head, right? Well, what they might not realize is that that plan might be fine as far as it might work, but they may actually be creating a much higher long-term tax bill.
Mm,
And, that's what we're trying to avoid. And so that's just called withdrawal sequencing, where you pull money from, when you turn on Social Security, when maybe if you have a pension, which I know a lot of people don't anymore, but if you do, when you turn that on and all these other things. So it all goes into the overall theme of controlling your taxable income over your retirement years. So that's a really, really big one.
yeah.
And there's a couple other ones too that we get into, but there's bracket management. But I will tell you that one of the big things that sometimes works if you got a major problem is you just bite the bullet and you do a major, like you realize a bunch of income in 1 year and you have IRMAA for that year, coming up, and you're just like, okay, I just did it. I ripped the Band-Aid off, but I'm not going to have it every year the rest of my life, or I'm going to reduce the amount of my Social Security that's taxable the rest of my life by biting the bullet in a given year or two, or that's kind of like that's a more extreme, but sometimes it makes sense because it's like long term, it saves you a ton of money in taxes. And we do have software. We have great software that actually lays out and gives us a really good starting point for any family to say, hey, what are your risks currently? If you just do what, the basic that a lot of people would do, and then how much can you save in taxes and these IRMAA premiums and all that stuff over your lifetime if you take some of these proactive approaches.
Yeah. The one thing that I'm walking away from this episode with, and the one thing I think listeners should walk away from this with, is that it is complicated. It's complex. It's involved, which typically for somebody like me means I need to get a professional on my side. I probably should sit down with somebody who understands this better than me because this is what they do for a living. In this case, it would be you. Uh, you know, I just sort of, it's like going back to that last episode. There are lots of things you can do yourself, but when you do them yourself, you don't have somebody there with you. You don't have a partner as a, certified financial planner helping you understand them and walk you through this stuff, Dan.
Yeah, and I think a lot of it is that, and what makes it the most difficult, it's not always one way. There might be three different ways to approach an issue, right?
Mm,
And so part of it is having those discussions and saying, "Hey, here's the pros and cons of these different ways. What do you think? What would make you most comfortable in being presented with, viable options, not just winging it?" Because I always think about TurboTax. Like, there's not really a TurboTax for retirement investment and tax planning. You know what I mean? Because it's just too complex.
yeah.
And even with TurboTax, and they've done a great job, and they're not the only ones, right? There's H&R Block, there's different programs
There's
out
a
there.
bunch of them now. Yeah.
Yeah, and they've done a really good job with helping a lot of people prepare taxes. But even if you notice today, a lot of them are now coming out with, "Hey, we're here for you when you have questions," because they're even realizing, yeah, the software is really pretty good, but it's not perfect, and you're going to have stuff that comes up you don't know how to do. And so they're having to provide support for that. And tax code's complex for sure. But when you put all the three things like we're talking about together, it kind of blows that away because it involves not only taxes, but also retirement income planning and, of course, investments. So,
Yeah. So to that end, if anybody's listening to this podcast and don't have a financial advisor, are thinking, well, this Dan guy sounds pretty interesting. I'd like to get in touch with him. How can they? What's the best way for them to reach out to you, Dan?
yeah, the first thing is, especially if these specific things are concerning to you, I would say number one, give us a call. We can sit down and we can actually give you that preliminary report and see if you even have a problem. Like, that's number one. And our phone number is 517-783-1695. I know in today's world, we go to websites, which has all our contact information, which is averywealth.com. You can put in, we'll reach out to you. There's a contact form. There's a lot of great resources out there as well, including all of our podcast episodes. But the big thing is that I always tell people, get that initial kind of report to tell you, hey, do I have anything to worry about? Because maybe you do, maybe you don't. I would tell you most people can make improvements. You may not be in a situation where you have this huge, catastrophic thing that you're facing, but you may too. So, I mean, it's kind of both ways. But if you get that preliminary report, you can start to identify, hey, do I need to start working on some of these things? Because time is your best friend. That's really a golden rule around money. The more time you have, whether it's investing or whether it's like putting together tax strategies, whatever. We live in an annual world for like tax planning and different things like that. So the more years you have available, the more things you can do to make really good progress.
That's excellent. The one thing you can do, by the way, really easy, is hit the follow button. If you're not a subscriber already, just become a subscriber, because that way every time a new episode is released by Dan, you're notified. You won't miss one, and you can give them a listen. And the other thing you could do, we're asking as a favor, is if you like the podcast, tell people about it. Share it with them, let them know, because word of mouth promotion is a very powerful tool, and we would very, very much appreciate it. If you missed any of Dan's information, don't worry. It's in the show notes, so you can go take a look at them there. You don't have to run the podcast back and re-listen to anything. It's right there, easy access for you. Until next time, I'm Bill Tucker on behalf of Dan Reese and everybody at Avery Wealth. Thank you. Appreciate you listening, and we'll catch you next time. Thank you for listening to Ramp Up Your Retirement. Click the follow button to be notified when new episodes become available. Visit our website at www.averywealth.com or give us a call at 517-783-1695. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Avery Wealth. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The opinions voiced in Ramp Up to Retirement with Dan Reese are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on the show may not be affiliated with CWM LLC. Views and comments by guests may not be representative of CWM LLC. Investment advisory services are offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.